So very quickly going through all the aspects of being part of a successful business. So Unit 6 is on financial and technological resources, and Chapter 17 is on managing business finances. So 17.1 is on financial management. And our objectives for this lesson are to identify the 6 reasons for creating a financial plan and explain what a budget is and how it is used. So when starting a new business or project at an existing firm, managers must determine if it's likely to be financially viable or financially successful. A financial plan is a set of documents that outline the essential financial facts about the new venture. It's basically a roadmap that can be used to guide a company into the future. Financial plan can also be used to attract investors and get that money. Lenders and investors provide money to businesses with sound financial plans. So an effective financial plan identifies the assets that need to be purchased, describes the amount of money a business needs to start and operate, describes the expenses the business will incur, and explains how a business will cover its expenses, describes how the business will document and report financial records, and forecasts finances to project future profitability, and finally explains how the business will acquire money to grow or expand. So, a financial plan identifies the assets needed for the business or project. And cash, equipment, buildings, supplies, inventory, and land are some examples of assets. Business owners and managers must make purchasing decisions carefully. They should research their options before buying business assets. They can analyze and compare the price of each item. The information obtained might show that buying used items instead of new ones or renting them would be best. Determining needed capital. A financial plan estimates the amount of capital the business will need. Capital is money supplied by investors, banks, or business owners of a business. Startup capital is the money used for the various assets and expenses of a new venture or business. A new business has no track record to prove that it will survive. For that reason, it may have a hard time attracting investors. Major sources of startup capital for entrepreneurs are personal resources, friends, family, and others. These resources can include savings, loans, and investments. Describing startup and operating expenses. A new business or venture has startup expenses and operating expenses. Startup expenses also often require a large amount of cash. Startup expenses include the cost of business assets as well as remodeling costs, security deposits, advertising, insurance, supplies, and legal permits and licenses. Operating expenses include payroll, rent, utility bills, delivery charges, and bank fees. Describing financial records management. A financial plan explains how a business will manage its records. It describes who will maintain the financial records and why. Some business owners maintain their own records. Others hire professionals for that purpose. A financial plan also describes any legal agreements that influence the way records are kept. For an existing business that is starting a new venture, the person who maintains the accounting records would probably keep the records regarding the new project. There are different types of accounting software available to businesses. A financial plan includes financial forecasts. A financial forecast is an estimate of business's financial outlook for each of the next few years. The forecast should consider business conditions in the future, including changes in the economy. A financial forecast might show that a new business or venture will not make money in the first year. It is best to be conservative when preparing financial forecasts. Keep estimates for income low and estimates for expenses high. So don't think the market's going to turn on you and suddenly, woohoo! All right. And our sixth reason is describing growth financing. Every company needs to grow in order to remain competitive. So planned growth can be very rewarding. Unplanned growth, however, can be quite chaotic. So investors and lenders want to know that a business has thoughtfully developed strategies to finance controlled growth. The financial plan should explain the company's plans for financial growth. Financial statements indicate the financial condition of a firm in a past period. However, a budget helps guide its future. A budget is a plan specifying how money will be used or spent during a particular period. Budgeting helps business owners predict how much money the business will need. It also helps to control spending. To avoid financial problems, business owners and financial managers sometimes need to compare the business's budget to its actual income and expenses. There are three main types of budgets. A startup budget is a plan for your income and expenses from the time you start a business to the estimated time it will make a profit. A cash budget is a plan for the actual money the business owner spends on a daily, weekly, or monthly basis. An operating budget is a plan for the amount expected to be spent and earned over a given period of time, usually about 6 months or a year. And that concludes lesson 17.1.